Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Seed Limited stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Garena is an online game developer and publisher headquartered in Singapore. Garena is the digital entertainment business under the parent company Seed Limited. The company distributes titles on Garena Plus in various countries across Southeast Asia and Taiwan. Its games include League of Legends and Hero of New Earth, FIFA Online 3, Arena of Valor, and Speed Drifters. In 2017, it developed Garena Free Fire, which has over 500 million registered users and over 80 million daily active users all over the world. Let's get started with the model. This is a large cap company, 141 billion market cap. They're trading at $275 a share and they have 512 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So in the past, they had negative free cash flow every year, except in the trailing 12 months, they had positive 68 million. Net income is the profit and loss on the income statement. It's revenue minus expenses, and they have negative net income every year. However, their revenue is growing a lot, from 400 million to 3.6 billion. That's a 9x revenue growth. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. Examples are cost of labor and cost of materials. The difference between those two numbers is their gross profit, and their gross profit has grown a lot in the past few years, from 80 million to 1 billion. Below that is operating expenses. Examples are depreciation, R&D, and insurance expenses. Then below that is their operating income, and they have negative operating income every year. Below that is the interest they pay in their debt. And then below that is other income and expenses. This is usually impairments or other non-cash gains and losses. Then below that is pre-tax income, then their taxes. They have earnings from equity interest. These are the earnings from its investments in other companies. Then the bottom line of the income statement is their net income, and they have negative net income every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. And they're starting to generate positive operating cash flow for the first time in 2019 and a lot more in the trailing 12 months. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they had their first positive free cash flow in the trailing 12 months, negative in prior years. Since the company has negative free cash flow, they need money from somewhere to run their business. They issued 1 billion of stock in 2017, then 1.5 billion in 2019. They're also issuing a lot of debt, 700 million, 600 million, 1 billion, then 2 billion. The only way a company can grow when it has negative free cash flow is to dilute its shareholders by issuing stock or to issue debt. But as long as the company is growing its revenue, it's doing a good job. And it looks like they're getting to a point where they're generating positive free cash flow, and that's going to grow even more as they grow their revenue. Let's look at the capital structure. $1.2 billion of equity, 1.6 billion of debt. They have 42% equity, 58% debt. Their net debt is negative 1.6 billion. So they could pay down all the debt with the cash on their balance sheet and still have 1.6 billion of cash left over. Their WACC is 7.4%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 85 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $68 billion. We divide that by 512 million shares. And we get a calculated stock price of 134. They're trading at 275, so they're trading at a 100% premium. It's a sell according to the model. Simply Wall Street is a little lower than me. They're at 121 a share. They're also saying the stock is overvalued. A traditional discounted cash flow model is to project the future free cash flows off of the past free cash flows. but they have mostly negatives in the past. So the future estimates were based off of what analysts expect the company to generate in the future. And I also looked through the company's financials and their competitors' financials to adjust those future free cash flows. The company IPO'd in 2017, and the stock was pretty flat for a while, but the past few months it's done really well. So if you bought the stock down here at any point, you could have made a really nice return. The company has a beta of 1.35, so the stock moves a little more than the market. The stock has gone up 460% in the past 52 weeks, much better than the S&P 500, which went up 16% in the same time frame. The 52-week low was 36, the high was 282. And the stock is trading above its 50-day and 200-day moving average. 3.7 million shares are traded each day on this stock, and of the 512 million shares outstanding, 290 million are on float, 71% are held by institutions, and there's less than 4% of the shares are shorted. Tennyson owns 23% of the stock. Then it looks like the founders of the company own some of the stock, also T. Rowe Price and Sands Capital. Let's look at their financial ratios. The average PE in the market's 10, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative net income and is in hyper growth mode like this, people look at the price to sales ratio. That's stock price over sales per share, and they don't have a good price to sales ratio. They're at 39, much worse than the median and average. Price to book is stock price over book value per share. That's 120, and the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have 1.2 billion of equity, 1.1 billion of tangible equity, because they have some intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense, negative EBIT, negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities almost 2 times. And their current assets are 3 billion of cash and $500 million of receivables. So it does seem like the company is well capitalized. They finally generated positive free cash flow, and they have 2 billion in working capital. Working capital is current assets minus current liabilities. The best way to look at ratios to compare them to similar companies. I've done videos on Activision Blizzard, Electronic Arts, Natent, and Zynga, all in the same industry as C. And if C has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're worse in everything except market cap. They're bigger than all the other companies combined because their stock price has been driven up so much. So to summarize, I have them trading at a 105% premium. This company is growing at a really fast pace. They're investing a lot in their business to grow it, so they're not taking any profits. They just want to grow the revenue, which is not a bad idea. Amazon was really successful with that, and Tesla is doing a good job with that same model. I ranked their free cash flow 6 out of 10. They were negative all along, but they finally got a small positive, which is good. I ranked their revenue as 10 out of 10. It doesn't get much better than this. And I rank their ratios 1 out of 10. Their ratios are pretty weak. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.